Picture this. You're looking at your tax bill, feeling overwhelmed. Now imagine being able to write off 65 to 80% of an investment against your taxable income. With oil and gas investments, that's not just possible, it's perfectly legal. Sound familiar? You work hard all year, only to watch a big chunk of your money vanish into the IRS black hole. It's frustrating, right? You're not alone. Millions of Americans feel trapped in this cycle, watching helplessly as their hard-earned cash disappears. But what if I told you there's a way to not only generate income, but also slash your tax bill at the same time? It's not a magic trick or a shady loophole. It's a legitimate investment strategy that's been hiding in plain sight. Stick around, because we're about to uncover an approach that could change everything for you. Ready to take control of your taxes? Let's dive in. Let's talk about a financial unicorn, an investment that generates income and slashes your taxes simultaneously. Sounds too good to be true, right? Well, it's not only possible, it's perfectly legal. Ever wondered why the ultra-wealthy seem to pay less in taxes? This might be their best-kept secret. Welcome to the world of oil and gas investments, where the IRS actually encourages you to participate. You heard that right. While most investments offer either income or tax benefits, oil and gas investments provide both. It's like having your cake and eating it too, but in this case, you're feasting on tax savings. So, what makes oil and gas investments so special? It all comes down to 3 key tax benefits that the government has put in place. First up, we have Intangible Drilling Costs, or IDCs. These are expenses that have no salvage value once the well starts producing. Here's the kicker. You can write off 100% of these costs in the year they're incurred. That's a massive upfront deduction that you won't find with your typical stock market investments. Next, we have Tangible Drilling Costs, or TDCs. These are the physical components of the well, like pipes and drill bits. While you can't write these off immediately, you can deduct them over the life of the well, typically 5 to 7 years. It's like getting a tax break that keeps on giving. But wait, there's more. Once your well starts producing, you get to take advantage of the depletion allowance. This allows you to exclude 15% of your gross production revenue from taxation. It's like the government is saying, hey, thanks for helping us produce domestic energy. Here's a bonus for your efforts. Let's put this into perspective with some numbers. Say you invest $100,000 in an oil and gas project. You could potentially write off up to $70,000 against your taxable income in the first year alone. That's a significant chunk of change that stays in your pocket instead of going to Uncle Sam. Now you might be thinking, this sounds great, but what's the catch? Here's the thing. There isn't one. The IRS actually wants you to invest in oil and gas. They've set up these tax incentives to encourage domestic energy production. It's a win-win situation. You get tax benefits, and the country gets more energy independence. But here's where it gets even better. The Tax Reform Act of 1986 classified oil and gas working interests as active income, not passive income. This means you can use losses from these investments to offset your active income, like your salary or business profits. It's a game changer that sets oil and gas investments apart from almost every other investment class. Think about it. With most investments, if you incur losses, you can only use those losses to offset other passive income. But with oil and gas, you can use those losses to reduce your overall taxable income. It's like having a secret weapon in your tax-saving arsenal. Now, imagine an investment that breaks every tax rule you've ever known. Sounds impossible, right? Well, prepare to have your mind blown. There's a little-known provision in the tax code that could slash your tax bill in ways you never thought possible. It's called the Tax Reform Act of 1986, and it's a game changer for oil and gas investments. This act did something extraordinary. It exempted oil and gas working interests from being classified as passive income. Why does this matter? Because it opens up a world of tax-saving possibilities that other investments simply can't touch. Here's the kicker. With oil and gas investments, you can offset your active income, that's your salary, business profits, or any other earned income, with losses from these investments. It's like having a financial superpower that defies the laws of tax gravity. Think about it. With most investments, if you incur losses, you're stuck. you can only use those losses to offset other passive income. But oil and gas, it's a whole different ballgame. Those losses can be used to reduce your overall taxable income. It's like having a secret weapon in your tax-saving arsenal. Let's put this into perspective. Imagine you're a business owner making $200,000 a year. With strategic oil and gas investments, you could potentially reduce your taxable income by tens of thousands of dollars. It's like getting a raise without asking your boss. And the best part? It's all above board. Now, you might be thinking, this sounds too good to be true. What's the catch? Here's the thing, there isn't one. The IRS actually wants you to invest in oil and gas. They've set up these tax incentives to encourage domestic energy production. It's a win-win situation. You get tax benefits, and the country gets more energy independence. But let's be clear, this isn't about gaming the system. It's about using the rules the IRS has put in place to your advantage. You're not breaking any laws. You're breaking free from tax constraints. It's a perfectly legal way to keep more of your hard-earned money in your pocket. Think of it this way. The government is essentially subsidizing your investment in the energy sector. They're saying, hey, we need more domestic oil and gas production. If you're willing to take the risk, we'll reward you with some serious tax benefits. It's like they're giving you a financial high five for participating in the energy market. So, what does this mean for you? It means you have a unique opportunity to not just invest, but to revolutionize your tax strategy. You're not just saving money, you're potentially changing your entire financial outlook. Think these tax benefits are just for big-time investors? Think again, there's a secret weapon in the tax code specifically designed for small investors like you. It's time to discover how David can outmaneuver Goliath in the world of oil and gas investments. Let's talk about the Small Producers Tax Exemption, introduced by the 1990 Tax Act. This game-changing provision exempts small producers from certain restrictions that larger companies face. It's like having a VIP pass to tax savings that the big players can't touch. But what does this mean for you? Simply put, it levels the playing field. As a small investor, you can enjoy benefits that were once reserved for the industry giants. It's like being allowed to play in the big leagues while still enjoying the perks of the minor leagues. Here's where it gets really exciting. With the right oil and gas investment, you could potentially enjoy up to 15% of your gross income completely tax-free. That's money in your pocket that the IRS can't touch. Let that sink in for a moment. But wait, there's more. Remember the alternative minimum tax, AMT? That pesky tax that often catches people off guard? Well, in 1992, the IRS introduced an exemption for Intangible Drilling Costs, IDC, that benefits independent producers. This means you can avoid additional tax burdens related to IDC, further reducing your overall tax load. Let's put this into perspective with some numbers. Say your oil and gas investment generates $100,000 in gross income. Thanks to these exemptions, $15,000 of that could be completely tax-free. It's like getting a bonus check every year, courtesy of the tax code. Now, you might be wondering, what if my investment doesn't strike oil? Here's the kicker. Even if your oil and gas investment doesn't succeed, you can write off nearly 100% of your investment against your taxable earned income. Compare that to stock investments, which have much stricter limitations on loss deductions. It's like having a safety net built right into your investment strategy. The IRS actually permits a tax write-off of approximately 65% to 80% from taxable earned income in the year of investment. That's a massive upfront deduction that can significantly reduce your tax bill right out of the gate. Think about the impact this could have on your financial future. These aren't loopholes. They're legitimate tax strategies designed to benefit everyday investors like you. It's time to level the playing field and take control of your taxes. Let's recap the game-changing benefits of oil and gas investments. You've got massive tax deductions, special credits, and unique exemptions that can slash your tax bill. But here's the kicker. Even if your investment doesn't strike oil, you can still hit the tax jackpot. Up to 100% of your investment could be written off against your taxable income. That's a win-win situation you won't find with other investments. Think about it. Isn't it time you stopped being a victim of high taxes and became the victor in your financial story? Oil and gas investments aren't just about making money, they're about keeping more of what you earn. It's like having a secret weapon in your tax-saving arsenal. So what's your next move? Don't let another tax season pass you by. Start exploring oil and gas investments today and take control of your financial future. Your wallet and your stress levels will thank you.